So I'm going to go over 5 lessons that I have learned over my investing career today. Now, if you guys appreciate the honesty, you appreciate this video, drop a huge like down below. Let's get 100 likes on this video, and also comment down below on which of these 5 lessons is your favorite. And I really believe that this video is going to help a lot of you out there, especially new investors that have just gotten into the market, but also more seasoned investors, because I have learned things over the years that I think may have been missed by some investors, and I hope that this video helps provide value to help teach you these lessons. So the first thing I would say is averaging down. So this is something that most people are guilty of not doing. So let me ask you this simple question. If you're holding a stock, the stock drops say 5%, but the fundamentals are still the same. Do you buy more shares? Do you sell your shares? Or do you just hold on to your shares? Most people will either hold or sell, panic sell, their shares and take a loss on that position. And this right here is the critical mistake that I want to teach you guys to not make. If the fundamentals of the business is still the same, why would you not want to pick up more shares at a cheaper price? That's like saying, oh, this t-shirt that I want is $100, but now it's on sale for $70. I don't think I want it at $70. I'll wait till it gets back up to $100 and then buy it. Makes no sense, right? So during the correction we had back in February, or even the correction that we're in right now, most people have begun selling their shares or panicking and bringing a lot of fear into their investments. But instead, what you should be doing is looking for which stocks still have strong fundamentals, which stocks you want to add more to your position in, and take advantage of the lower prices to average down on your position. Doing this will translate to higher gains in the future when the stock price does eventually recover. And the second thing I want to go over with you guys is patience. So this is one of the biggest things that I see with investors, both new and seasoned investors, is that they lack patience. So when these investors buy a stock, say they buy Apple for $100 per share today, they want to see that stock go up in price right away, whether that's the same day or even the next day. They don't want to hold the stock for the next few days, weeks, months, or even years and have the stock price be the same still. They want to see instant gains, instant returns on their money, and that is where the mistake comes in, and that is where they're lacking patience. So if you're patient and you implement lesson number 1, which is averaging down, you will end up with much better gains, much higher gains in the future. Patience is really the name of the game when it comes to investing. And if you're patient with your investments, you have a strategy in place, you average down, you will most likely come out with much larger gains than you would have if you short-term bought and sold the same stock. Remember, when you hold for the long term, you have things like compound interest, you have things like the strong rallies in the market, all in your favor, and you're not going to miss out on any of these things. Now, the third lesson is buying on fear. Now, I have to say that this right here has provided tons of opportunities for me, both from a long-term and a short-term perspective. So when bad news comes out, whether that's in a stock that you're holding or watching, or a macroeconomic event comes out and affects the market as a whole, most people should be buying stocks at this point because stock prices are now lower, and they should be averaging down on their positions. But what most investors do, like we talked about, is that they let fear take over and they sell their positions at a loss. And really, by doing this, you're falling into the media scare tactics, and you're just providing a lot more commission income for your broker. So think about who's benefiting when you do sell out at a loss. And just in case you're wondering, the answer is not you. Again, looking at February or the recent months, all we see in the media is that this is the beginning of a bear market, this is the beginning of a recession, we should sell our stocks, we should buy defensive stocks, we should not be holding any growth stocks, and we should just sit on the sidelines here and just watch this happen. And honestly, they could be right. This could be the beginning of a bear market, this could be the beginning of a recession. But the point is that it doesn't really matter though if you're a long-term investor. When you see headlines like stock market crash or bear market or recession, most people start panicking, most people bring fear into their investment decisions, and they sell their stocks at a loss when you should be looking to buy at these points. So this is something I love to implement not only in my long-term investments, but in my swing trade investments as well. What I do is I wait for a company to report their earnings. Maybe they had a miss on guidance, maybe they had a miss on their revenue or something like that, and the stock price plummets, and I just watch investors flee the stock. And while they're selling out of this position and they're fleeing the stock because this is a struggling company, this company is going to go down, I look for an entry point and I try to enter these stocks when they are dipping down below, average down if they go even lower, and then just ride the wave back up as they recover to their prices before the earnings report. Now, this was much easier to do in 2017 or even say the beginning of 2018. But the second half of 2018 has made it a lot harder to do with the broad market correction. But that doesn't mean that there aren't opportunities out there. It just means that it does take a lot more work to find these opportunities. Now, I'm personally confident that this is exactly what's happening right now with Apple and Facebook. People are really fearful of these stocks. They don't really know what's going to happen with these companies. And honestly, both these companies are in a strong financial position. They have strong moats around them as well, in my opinion. And when I look at these companies a few years from now, I see a lot more upside than where the stock price is currently. Now, the fourth lesson, which is very important, is picking strong companies, not penny stocks. So just like many people, the first stocks that I went and purchased to invest, to trade, were penny stocks. They were cheap. They had big price swings, and they gave you the illusion that you can become a millionaire from owning these stocks overnight. So it did take time, but I did learn eventually that this is not the way to go with investing, and that even the most successful investors ever will never ever touch penny stocks. Sure, you have the potential to gain 100% on your investment in a very short period of time with these penny stocks, but you also have the same potential to lose 100% of your money in a short period of time. And in my opinion, the volatility on these penny stocks is even more extreme than we've been seeing in the market recently. So just keep that in mind. When you see price swings of 50, 60, 70% up or down in a single day, that can really toy with your emotions. So once I started trading more blue chip stocks, companies typically with $1 billion market cap or more, I found to be my gains a lot more consistent. The stocks didn't have as wild of price swings as penny stocks, so there wasn't as much potential to make 100% of my money, but that's not what I'm looking for with these investments. I'm looking for slow, consistent gains over time, and that's exactly what blue chip stocks provide. This really helped me work on my patience, really helped me work on averaging down, because I wasn't really fearful that these blue chip companies would go out of business in the next month or so. And that right there is kind of the key problem when it comes to penny stocks, in my opinion. There's a very high chance that your investment could go to $0 or very close to $0, and essentially that whole investment is then lost. But here's the question, can you see a company like Google going to $0 anytime soon? Probably not, which is why I stick to these blue chip companies now for my investments. So the fifth lesson here is having a game plan. Now guys, I can't stress the importance of this enough. You need to have a game plan before you put a single penny into the stock market. So now what I do in my investments is I take my time, I look at all the lessons I talked about today, and I implement that into my investments, both in my swing trade and my long-term trade. Now, if it's a long-term position that I want to enter, I look for a good price beforehand that I would like to buy the stock at. I wait for it to dip to that price, and as soon as it hits that price, I buy. Now, personally, I use things like technical analysis to figure out good entry prices for my stocks. But if you're a long-term investor, you don't really care about that. You just want to buy and just hold as long as possible. You can just dollar cost average over time. Every time the stock price drops, say 5-10% or something like that, you add more to your position. Now, if it's a swing trade position, I figure out both my entry and exit price before I enter the stock. Usually when I do swing trades, I look for, say, between a 5 to 20% upside. So if we're in that range, I'll typically sell. But I do have a predefined price that I set. As soon as I buy the stock, I set a limit order to sell that stock at a 20% or so upside. This way, I know exactly when to sell the stock. It'll automatically trigger if it does hit that price and I hit my 20% gain. But in some cases, the stock price might move the other way. In that case, I've also accounted for the downside in this, and I might cut my losses there as well. But pretty much the gist here to understand is that you need to have a strategy depending on what you plan to do. If you're swing trading, you need to know exactly when to buy the stock, when to sell the stock, and when to cut your losses on the stock. If you're long-term investing, you may just want to look for entry prices where you want to keep adding to your position to dollar cost average or average down on your position. So I really hope that this video helped to give you insight into how I invest and things I learned over my investing career. So I've made mistakes. I'm not a perfect investor myself, and you can see the mistakes that I've made up in this video here. But I do believe that these mistakes have helped me become a much better investor today. By implementing these lessons that we talked about today, I have become a much more successful investor, and it has offset any losses that I did incur at the beginning of my investing career when I dabbled in penny stocks. Now guys, I don't really push this too often anymore, but if you are interested in seeing my portfolio, I will leave a link down in the description below. You can go check it out. You can see exactly what stocks or options I own in my swing trade or long-term portfolio. But either way guys, if you like this video, please help get it to 100 likes. I really appreciate that. And also comment down below on what your favorite lesson was from this video. Thank you for watching guys. Hope you enjoyed it. Hope you learned something from this video. But either way, don't forget to invest positively. Peace.